Welcome to a new episode on the Gap Advisors and AS Clinic podcast.
Right.
We were jumping into a really fascinating deep dive today. And look, if you are a CA student or maybe an auditor staring down a really complex engagement, or even a finance professional managing a corporate balance sheet, you are essentially the crucial third person in the room with us today.
Yeah, absolutely. We're going to be dissecting the real granular mechanics of Indian accounting standards today. Specifically, we're looking at how a seemingly administrative update, a little tweak to a company's financial footnotes, can completely alter the entire narrative that's presented to the market.
Right. The narrative is everything. But before we get into the weeds on that, let's lay down the ground rules so we're all operating from the exact same baseline.
Always a good idea.
So for the financial statements we're analyzing today, the functional currency and the presentation currency is the Indian rupee, or INR. Any currency that is not the functional currency is basically treated as a foreign currency.
Right.
And furthermore, the reporting period we are looking at begins on the 1st of April and ends on the 31st of March.
Establishing those parameters is so critical because, well, in financial reporting, the framework completely dictates the interpretation. You can't analyze the numbers without knowing the boundaries of the playground, so to speak.
Exactly. Now, regarding the origin of our discussion today, I want to make it clear that this isn't some theoretical textbook exercise.
No, not all.
The observation we're breaking down comes directly from the published Ind AS financial statements of a listed company. And these statements were actually downloaded and independently reviewed by Gap advisors on a suo motu basis. They just pulled the publicly available data and rigorously analyzed the application of the standards.
Which is, it's an incredibly objective look at how the standards are actually being applied out there in the real market. That kind of independent review is incredibly instructive for anyone preparing or auditing these documents.
Oh, for sure. And actually, on that note, if you are finalizing your own financials right now, it is highly advisable to get your financial statements reviewed by Gap advisors before signing them.
Better safe than sorry, right?
Exactly. You can actually submit your financial statements in a near-to-publishing PDF format by email to info@gapadvisors.com. It's a massive safety net. And today's specific observation was actually featured in the 222nd edition of the Gap Advisors Task Weekly newsletter.
Oh, that's a great newsletter.
It really is. It was authored by CA Minish C. Iyer, who is the director at Gap Advisors, and it's published right there on LinkedIn. They've actually published over 230 editions to date. So, if you are on LinkedIn, definitely subscribe to that newsletter for free.
It's a goldmine of technical insights. But as always, before we dive into the actual case, we must include our standard disclaimer.
Right, let's get that out of the way.
So, the views expressed in this deep dive are the personal views of the author and are not binding on the audience. The audience is requested to seek the help of an expert before taking any action or refraining from any action based on the views discussed herein.
Perfect. Okay, let's set up the situation. We have this listed oil and gas company, right? And in their financial statements, they disclosed what they proudly called a change in accounting policy regarding their oil and gas decommissioning costs.
Right, which sounds totally normal.
Exactly. On the surface, it reads like a routine administrative update. Oh, we just changed a policy, moving on. But upon that independent review by Gap advisors, it became super apparent that this little declaration was actually masking a prior period error.
And that right there is the crux of the matter.
So our mission today is to unpack the technical difference between a simple policy change and an actual error under Ind AS 8, and, explore why that distinction fundamentally changes the reality of a balance sheet.
Because that distinction is honestly everything. Two different paths might lead to a mathematically similar adjustment on the balance sheet at the very end of the line, sure. But the narrative you provide to the regulators and the shareholders regarding how you actually arrived at that number, that is heavily, heavily regulated.
Okay, let's unpack this. Let's start with the company's actual claim. In their financial statements, this was specifically in Note 54.1.2, they disclosed that based on the opinion of the Expert Advisory Committee of the Institute of Chartered Accountants of India, they changed their accounting policy regarding the excess decommissioning provision written back.
Right. And before we even look at the mechanics of that accounting change, let's quickly define the scope of a decommissioning provision for everyone listening.
Yeah, that would be helpful.
So when an oil and gas company builds infrastructure, let's say they build a massive offshore drilling rig, they incur a legal or sometimes a constructive obligation to dismantle that rig and restore the environment when the extraction is totally complete.
So they basically know they have this massive cleanup bill coming due in, what, 20 or 30 years?
Precisely. And under the standards, they absolutely cannot wait 30 years to recognize that massive cost. They have to estimate the future cost of dismantling the asset right now, discount that future cash outflow to its present value using an appropriate discount rate, and then recognize that present value as a provisional liability on their balance sheet today.
Okay, got it.
And simultaneously, because this future cost is directly attributable to bringing the asset to its working condition in the first place, they capitalize that present value. So they essentially add it to the carrying amount of the oil and gas asset itself.
Okay, wait, let me wrap my head around this. So this is like setting aside money to tear down a house you just built, right?
Yeah.
The initial cost of the house, or the oil rig in this case, includes both the cost to build it and the present value of the cost to eventually tear it down.
That's a great analogy, yes.
And then over time, I assume two things happen mechanically on the books. First, the asset is depreciated or depleted, and second, that liability slowly increases as you unwind the discount, kind of moving closer to that actual future cash payout.
That is the exact baseline mechanism. You've got it perfectly. But the core issue here, what this whole case revolves around, is what happens when that initial estimate changes.
Because things rarely go exactly to plan over 30 years.
Exactly. Estimates for a 3-decade project are inherently volatile. I mean, the inflation rate changes, the actual technology for dismantling rigs gets cheaper or more expensive, or the discount rate itself shifts.
So the company's footnote was basically explaining their new method for handling a drop in that estimated future cost.
Correct.
And the mechanics they described were twofold. First, they said any change in the present value of the estimated decommissioning provision, excluding the normal periodic unwinding of the discount, of course, is adjusted to the decommissioning provision itself. And then an equal adjustment is made to the carrying amount of the related asset.
Meaning, if your estimated teardown cost suddenly drops because of new technology, you reduce your liability and you also reduce the carrying value of the oil rig on your balance sheet by that exact same amount.
Right. Okay. But then they had this secondary condition attached to it. They stated that if the reversal of the decommissioning provision actually exceeds the carrying amount of the related asset, which includes the written down value of the capitalized portion of the provision, that excess amount is recognized in the statement of profit and loss.
Let me illustrate that secondary condition because it can get a bit abstract.
Please do.
Imagine an older oil well where the carrying amount of the asset has been heavily depleted over the years down to, let's just say, 10 million rupees. But due to some massive downward revision in teardown costs, your liability actually needs to be reduced by 25 million rupees.
Okay, so a huge drop in the estimated cost.
Right. So you reduce the liability by 25 million. Then you reduce the asset by 10 million, which takes the asset value completely down to zero.
Because you obviously can't reduce an asset below zero.
Exactly. You hit the floor. So that remaining 15 million rupee adjustment has to go somewhere, right? The company stated that their new policy would be to recognize that remaining 15 million directly in the statement of profit and loss.
Basically counting it as profit.
Yes. And what's fascinating here is that they presented this entire mechanical treatment as a brand new accounting policy, adopted specifically because they sought and received an opinion from the Expert Advisory Committee, the EAC.
I mean, it sounds very proactive on their part, like they're really trying to get it right.
It does sound proactive, but changing the value of a major asset doesn't just sit in a vacuum on the balance sheet. It triggers a massive chain reaction throughout the financials.
Right, because actions have consequences.
Yeah.
And the source analysis explicitly details this cascading impact. This one single adjustment to the future teardown estimate literally resulted in a decrease in 5 distinct areas of their reporting.
5 distinct areas, yes.
Let me list them out. It decreased the carrying value of the oil and gas asset, the valuation of inventory, the excess decommissioning provision written back, the change in inventory of finished goods, and the depletion expenditure in earlier years.
Let's trace that logic for the listener because it's a perfect real-world illustration of how interconnected Ind AS really operates. Let's focus on the relationship between the first item, the decrease in the carrying value of the asset, and the fifth item, the decrease in depletion expenditure.
Okay, wait, hold on. I want to make sure I'm not losing the thread here between a long-term oil rig and the actual warehouse holding the product. Walk me through the math of depletion because it's slightly different from standard depreciation of, say, a factory machine, right?
Yes, it is. For a standard factory machine, you usually depreciate it straight line over a set number of years, 5 years, 10 years, whatever. But for natural resources like an oil well, The useful life isn't time-based. It's determined by the estimated reserves in the ground.
Ah, the unit of production method.
Exactly. So if your capitalized asset cost is, say, 100 million rupees, and you estimate there are 10 million barrels of oil in the ground, your depletion rate is simply 10 rupees per barrel.
Okay, so if you extract 1 million barrels in a given year, your depletion expense for that year is 10 million rupees. That makes sense.
Right. Now, let's bring in the company's accounting adjustment. By reducing the estimated decommissioning liability, they reduce the overall capitalized cost of the oil well.
Okay.
Let's say that 100 million rupee asset base drops to 80 million rupees. Now, assuming the estimated reserves in the ground stay exactly the same, your new depletion rate drops from 10 rupees per barrel down to 8 rupees per barrel.
Oh, I see. So for all those earlier years where they were applying the higher 10 rupee rate, their depletion expenditure was technically overstated based on this new math. By adjusting the asset value downward today, the depletion expenditure for those earlier years decreases retroactively.
And that brings us directly to the second and fourth dominoes on your list: the valuation of inventory and the change in inventory of finished goods. Under Ind AS 2, the cost of inventory has to include all costs of conversion and other costs incurred in bringing the inventory to its present location and condition.
Right. And for an oil company, depletion is a primary, undeniable cost of conversion.
Because you literally can't get the crude oil into a barrel without depleting the well. It's impossible. So if the depletion cost per barrel drops from 10 rupees to 8 rupees, the cost you assign to the physical inventory sitting in your storage tanks also drops.
The valuation of the inventory decreases.
Huh?
That's wild. Here's where it gets really interesting. One tweak to a future teardown estimate, something that might not happen until 2050, literally changes the value of the finished goods sitting in the warehouse today.
It absolutely does. And if your opening inventory was previously valued at that higher rate, adjusting that inventory value downward directly impacts your cost of goods sold, which, in turn, alters your reported profit margins on the oil you sell during the current period.
It's staggering when you map it out like that. Everything is so tightly woven together. And what about that third item on the list? The decrease in the excess decommissioning provision written back.
Ah, right. That basically means that because they were now systematically reducing the asset value first, rather than just dumping the entire liability reduction straight into the P&L as a massive gain, there was less excess hitting the income statement immediately.
I see. They're bringing their accounting mechanics into a very structured step-by-step process. Asset gets reduced first, and only the leftover hits the P&L second. And again, they presented this entire complex chain reaction to the market as a voluntary, proactive change in accounting policy.
Which brings us to the real core mystery of this deep dive.
Right. Because I'm looking at this from the outside, and I'm genuinely puzzled. If this is a massive listed oil and gas company with highly sophisticated auditors, why did they even need to consult the expert advisory committee on this? Was the standard really that ambiguous? Were there, competing interpretations in the industry on how to handle a drop in a liability estimate?
That is the exact question that the Suo Moto review by DAP advisors interrogates so brilliantly, and the answer is the absolute turning point of this entire analysis.
Which is?
There was absolutely zero ambiguity in the standard, none.
Wait, really? This is the revelation regarding Ind AS 16, right?
Mm-hmm.
The independent review points out that Appendix A of Ind AS 16, which covers property, plant, and equipment, is specifically titled Changes in Existing Decommissioning, Restoration, and Similar Liabilities.
Yes.
So what exactly does Appendix A mandate then?
Appendix A explicitly mandates the exact mechanical treatment the company claimed as a new policy. It dictates very clearly that changes in the measurement of an existing decommissioning liability must be added to or deducted from the cost of the related asset in the current period.
It's already in there.
Yes. Furthermore, it explicitly states that secondary condition we talked about. If a decrease in the liability exceeds the carrying amount of the asset, the excess shall be recognized immediately in profit or loss.
Wait. So the standard already required this exact step-by-step treatment.
Yep. Word for word. It is not a suggestion. It is the mandated standard. And critically, this treatment was required well before the opinion of the expert advisory committee was ever issued to this company.
So the EAC didn't invent this methodology?
Not at all. The EAC merely reiterated what was already explicitly written in black and white in Appendix A of Ind AS 16.
Wow. So if Appendix A already mandated this, the company wasn't choosing a new path at all. There is absolutely no accounting policy choice given in Appendix A of Ind AS 16 to label this treatment as a change in accounting policy.
None whatsoever. Think about it. An accounting policy choice implies that the standards actually permit more than one acceptable method. For instance, choosing between the FIFO method or the weighted average method for your inventory valuation. Moving from one allowed method to another, that is a legitimate change in accounting policy.
Because you have options.
Exactly. But in this scenario, Ind AS 16 provides only one acceptable method.
So what does this all mean? It's like getting pulled over for running a red light and telling the cop you're just implementing a new personal driving policy of stopping at red lights from now on. The rule was already there. You don't get credit for adopting a policy when it was already mandatory.
That analogy hits the nail on the head. You were simply breaking the rule before. By labeling this as a change in accounting policy, the company was framing their newfound compliance with an existing mandatory rule as if it were some proactive elective upgrade.
That is wild. And that brings us to the harsh reality of Ind AS 8. Because if it wasn't a change in policy, then what was it? You don't just recalculate your historical depletion and inventory valuation for the fun of it.
No, you don't.
But if they weren't following the Appendix A before, then their prior financial statements were fundamentally non-compliant.
Right. And this requires us to look at how Ind AS 8 strictly defines errors, because the standard is very specific about what constitutes a failure in reporting.
Okay, let's break down the concept of Ind AS 8 then, without getting too bogged down in the textbook jargon. I have the definition from the source text right here.
Go for it.
It says, prior period errors are omissions from and misstatements in the entity's financial statements for one or more prior periods arising from a failure to use or misuse of reliable information that A, was available when financial statements for those periods were approved for issue, and B, could reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements.
Okay, if we connect this to the bigger picture, conceptually, Ind AS 8 says that an error occurs when a company omits or misstates information, and that failure stems from simply ignoring or misusing reliable information that was sitting right there available to them at the time.
And it also specifically says in the text, such errors include the effects of mathematical mistakes, mistakes in applying accounting policies, oversights or misinterpretations of facts, and fraud.
Exactly. The key test is, was the information available when the financials were approved? And could the company reasonably be expected to have known about it?
Well, in this case, Appendix A of Ind AS 16 was unequivocally available. It's literally the primary standard for their most significant class of assets. I mean, you can't claim ignorance of the standard while simultaneously capitalizing a decommissioning provision in the first place, right? The provision only exists on the books because of the standard.
That is a fantastic point. They knew the standard existed. And Ind AS 8 explicitly lists mistakes in applying accounting policies as a prime example of a prior period error. The company had all the reliable information, they simply made a mistake in applying the mandatory policy regarding changes in existing decommissioning liabilities.
They just got it wrong.
Yeah, they either completely ignored Appendix A or horribly misinterpreted it in their previous filings. By failing to follow Appendix A initially, they committed a prior period error.
So, bringing their current accounting mechanics into alignment with Appendix A today is not a policy change. It is the rectification of a prior period error. Full stop.
It is the definitive classification under the standard. There's no other way to slice it.
Okay, now let me push back a bit on behalf of the finance teams listening, because I can hear the arguments already. If the math ultimately works out the exact same, if the asset is reduced, the inventory is adjusted, and the P&L absorbs the excess, whether you call it a policy change or an error rectification, why does the terminology matter so much?
It matters a lot.
I mean, why is GAAP advisors flagging this as such a major issue if the final numbers on the balance sheet end up in the right place anyway?
Because, and this is crucial, financial reporting is not just about the final number at the bottom of the page. It is about the disclosure surrounding that number. The terminology you use dictates the disclosure requirements, and the disclosure requirements dictate market perception.
Okay, walk me through the difference in what a company actually have to publish in their footnotes, depending on which label they use.
Yeah.
Because clearly, the disclosures differ drastically.
Drastically. When a company declares a voluntary change in accounting policy, the narrative is inherently forward-looking and positive. The disclosures focus on explaining how the new policy provides more reliable and more relevant information to the users of the financial statements.
It signals management's proactive optimization. It's strategic PR. Hey, everyone, look at us. We found a better way to represent our operations.
Exactly. It makes them look good. But when a company declares the rectification of a prior period error, The narrative fundamentally shifts. The disclosures required under Ind AS 8 for an error are highly stringent and very backward-looking.
What do they have to say?
A company must explicitly state the nature of the prior period error. They must publicly disclose the amount of the correction for each financial statement line item affected for each prior period presented.
Oh, wow. So they have to publicly detail exactly how badly they messed up the math in the past.
Yes, they do. They essentially have to publish a third balance sheet as at the beginning of the preceding period, just to show the cumulative effect of the error. It is a public, undeniable admission that the financial statements the market relied upon previously were unreliable because the company failed to properly apply a mandatory standard.
And the psychological impact of that on investors and analysts is massive. A policy change invites nods of approval, and error restatement invites intense, uncomfortable scrutiny.
Exactly.
It makes the market wonder, well, if the internal controls failed to apply a mandatory section of Ind AS 16, what other standards are being misapplied behind closed doors?
Which is exactly why the distinction matters so much. By intentionally or unintentionally classifying the adjustment as a change in accounting policy, the company completely bypassed the rigorous, scrutinized disclosures required for rectifying a prior period error.
They sidestep the punishment.
Yes. Therefore, as the Suwamoto Review concludes, they have not complied with Ind AS 8. The standards are specifically designed to prevent this exact kind of narrative arbitrage.
Narrative arbitrage. That is a great phrase for it. And it's a profound finding. It really shows how the narrative can be manipulated even when the underlying math is eventually corrected. But you know what I appreciate about this analysis from GAAP advisors?
What's that?
It doesn't just stop at pointing out the flaw in one company's financials. It actually proposes a structural solution for the broader industry to fix this.
Yes, diagnosing the symptom is only half the battle. We have to look at the structural environment that allows this kind of ambiguity to persist in the market, and that leads directly to the role of the expert advisory committee itself.
Right. The analysis details a really specific recommendation regarding the EAC. It suggests that when the EAC issues an opinion in response to a query, they need to proactively clarify the exact nature of the required changes.
Because currently, here's what happens. A company might write to the EAC asking for the mechanical treatment of an issue like, how to account for the excess decommissioning provision. And the EAC provides the correct mechanical treatment, often by directly referencing the relevant standard, like Appendix A.
But they just give the math.
Exactly.
But the GAAP advisor's recommendation goes a step further. They are arguing that the EAC shouldn't just provide the mechanical math. They should explicitly state, in their opinion, whether bringing the accounting treatment into accordance with that opinion results in a change in accounting policy, a change in accounting estimate, or a rectification of a prior period error.
And crucially, the EAC should provide this categorization regardless of whether the submitter actually asked that specific question.
This raises an important question, though. Why is that proactive categorization from the EAC so critical for the ecosystem? What behavior is it really trying to prevent?
It prevents what I like to call the EAC shield phenomenon.
The EAC shield.
Yeah. Right now, a company can realize internally that they've been making a massive error. Instead of just admitting the error and restating their financials, taking the PR hit, they write to the EAC to ask for the correct treatment. Once they receive the opinion, they implement the correction, but they tell the market, hey, we're updating our policy based on recent expert advice from the EAC.
Oh, I see. They use the prestige of the EAC to legitimize a past mistake as a modern innovation. They hide behind the committee.
Exactly. But if the EAC opinion inherently includes a clause that says, explicitly, applying this mandatory standard constitutes the rectification of a prior period error, the company completely loses that shield.
They can no longer point to the EAC opinion to justify a policy change disclosure because the opinion itself calls it an error.
Right. It forces consistent, transparent financial reporting across the entire market.
Because without that, you end up with a severe lack of comparability. I mean, Company A might correctly identify an oversight, take the PR hit, and publish the rigorous error disclosures. Meanwhile, Company B makes the exact same oversight, consults the EAC, labels it a policy change, and totally avoids the scrutiny.
And the underlying reality is identical, but the market treats them completely differently. which fundamentally undermines the core objective of Ind AS, providing relevant, reliable, and comparable information to users.
Man, this dynamic places an incredible burden on auditors. Think about it. If you are an auditor reviewing management's draft financials and management insists on calling an adjustment a policy change backed by an EAC opinion, you need immense technical conviction to push back and demand it be classified as a prior period error.
Oh, absolutely. You can't just operate on a hunch in those boardroom meetings. You need documented, defensible technical logic. Documentation is the ultimate defense mechanism of the audit profession.
Which perfectly transitions to an incredibly powerful tool available to our listeners, especially the auditors who need to document exactly how they address issues like this. If you are navigating these nuanced technical disputes, you really need to utilize the issue repository on gadgetadvisors.com. Let me spell that out. GAHPAD-VISO.com.
That repository is a massive asset for standardizing application across the board.
It really is. It hosts over 4,500 issues, and their detailed responses regarding Ind AS and Indian Gavel. That is an enormous database of real-world application dilemmas that have been technically resolved.
And it's incredibly accessible.
Totally. Furthermore, any person can register on the site for free. Once you're registered, you can submit specific issues on Ind AS and Indian GAAP and receive a detailed technical response delivered directly to the inbox of the email you registered with on indas's.com.
For an auditor sitting in a contentious meeting with a CFO about whether an adjustment is an error or a policy change, having access to that repository or being able to submit the specific fact pattern for an independent, documented response, it's just invaluable.
It removes the subjectivity completely.
Right. It grounds the discussion strictly in the mechanics of the standards. And you need that documented response in your audit file to demonstrate how you address the application of Ind AS in complex situations, just like the one we discussed today.
It empowers the auditor to say, look, the standard dictates this is an error, and here's the technical breakdown validating that interpretation. It's an essential layer of armor in the financial reporting process. Registering is free, so there is truly no reason not to integrate it into your workflow today.
The complexity of modern balance sheets honestly demands that level of rigorous technical support. You cannot navigate the intersection of long-term liability estimates, asset valuations, and depletion cascading without it.
The interconnectedness we discussed today, how a 30-year estimate alters today's inventory value in the warehouse, proves that point entirely. It shows how vital it is to get not just the numbers right, but the narrative right.
Because when the narrative is misaligned with the standards, the market's understanding of the company's historical performance is fundamentally distorted.
Which brings up a fascinating forward-looking thought that I want to leave you, our listener, to mull over. Think about the financial statements you'll review tomorrow. But let's take it a step further. We are entering an era where AI and complex algorithms are increasingly being used to draft initial accounting policies, scan standard updates, and even analyze EAC opinions to suggest financial statement drafts.
That's a very real shift happening right now.
Right. So if an algorithm suggests framing an adjustment as a policy change to optimize the market narrative and passes through a rushed human review process, who ultimately takes the fall when a suo motu review catches the prior period error, does the CFO blame the software? Does the auditor blame the algorithmic output?
It's a profound question of liability and ethics.
As the tools we use to build the narrative become more automated, the human responsibility to interrogate the nature of the adjustment, asking, is this truly a choice or is it a correction, becomes more critical than ever.
Automation can handle the mechanics of depletion and present value calculations flawlessly, sure, but defining the nature of an event under Ind AS 8 requires human judgment and an uncompromising commitment to transparency.
So when you see a change in accounting policy proudly declared in the footnotes tomorrow, ask yourself, is this truly a new policy? Or is it a prior period error in disguise? Are the disclosures hiding the reality of a past mistake?
The more professionals who can spot the difference between a genuine policy shift and a masked error, the more robust our capital markets become.
Absolutely. Please share this podcast among your contacts, your colleagues, your audit and finance teams, and especially any students pursuing the CA course to help spread the knowledge of Indian accounting standards. It really helps the ecosystem.
It elevates the entire profession.
Thank you so much for your time today and for diving deep into the mechanics of Ind AS 16 and Ind AS 8 with us. We request you to follow or subscribe to the Gap Advisors Ind AS Clinic podcasts on Spotify, Amazon Music, and YouTube, whichever platform you prefer to listen to Gap Advisors Ind AS Clinic podcasts. See you next time.